My mission is simple: to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make some money. My job is not just to entertain you, but to educate you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Close watchers of Mad Money know I'm not a chartist, but I do play one on TV weekly, showing you technical patterns that can predict the next big move for stocks. Given that I base almost all of my work on fundamental factors related to the companies I study and not the shape of their charts, the off-the-chart segment is both heretical and antithetical to my traditional stock-picking methods. But I know from your feedback at Jim Cramer on Twitter that you're interested in this analysis. And importantly, it's proven itself time and time again to really get a lot of people involved at the right level, say. Now, not for a minute, as I explain in Get Rich Carefully, where I devote a whole chapter to charting, have I become a chartist myself. I still single out stocks to highlight and teach about after studying the fundamentals, the research, the annuals, the sectors, and I overlay them on my broader worldview at the moment. Chartists can care less about this stuff. They often don't even care what the company does. I wonder if they could do their jobs with the company's names blacked out. In fact, I am sure they could. Some of them hate the distraction of knowing much at all about a company for fear it would bias them against the stock's chart. Can you imagine? Now, I've become pretty proficient at charting over the years, but I still rely on the individual work of professional technicians to demonstrate how to use charting and to learn techniques that I can in turn teach you. That's why tonight I am picking the best of the best charts of some of the best technicians we have worked with, exploring the patterns that have become reliable to the point where I'm pretty astonished at how accurate they can be. So I guess you got to call me a long-term believer. Hey, you know what? That's why I've started nearly every Saturday morning for the last 30 years reading the Standard & Poor's Trendline Daily Action stock charts, formerly on paper, now on electronic distribution. And they contain hundreds of charts. And I match those charts with the patterns I have learned over time. I then go over the research available for the most winning of the charts, and they often become segments on the show that you see later in the week. Why do the charts work? That's what people always want to know. First, you must consider them as if they are footprints at the scene of a crime. These footprints trace out what big money managers might be doing with their buying and selling of dollars. These portfolio chieftains at large funds often know more than others, including you and me. The charts of where their money goes, the charts of the stocks, put together clues that these big boys leave. Second reason to care, there's a remarkable self-fulfilling nature of charting stocks. So many professionals look at these drawings and take them to heart that they will simply avoid stocks with predictably terrible charts and find stocks to own, stocks with charts that have presaged positive moves in the past. Don't I know it? When I work with Karen Cramer, she's an inveterate chartist at my old hedge fund, she would look at the charts each morning, seeking ones that stood out as potential breakouts and breakdowns, and then have me research the ones with most predictable patterns to get a handle on what might really be going on. We got some of our best ideas from some of those chart-inspired brainstorming sessions, a true and successful melding of the technicals and the fundamentals to produce excellent short and long-term results. All of charting and technical analysis starts not just with the pictures of individual stocks, but also what are known as the internals. Patterns about stocks in the aggregate that give you clues to the direction of the entire stock market. For years now, ever since the Great Recession, that showed the inherent weakness in our financial system, that so-called systemic risk I talked about, there has been tremendous skepticism about any advance of stocks. While I believe the systemic risks have been reduced, I know each rally creates a worrisome set of risks. I know many of you fear that you're coming in at a level that could turn out to be, let's say, too late, too high, and you will lose money either way. Sell, sell, sell. Good technical analysis includes analyzing indicators to help you determine the overall direction of the market. More important than ever, given that so many stocks are influenced mightily by the tug of the S&P 500 stock futures. Sometimes, to technicians, everything hinges on putting together the charts of individual companies and the charts of the bigger averages to create comparisons that elucidate and illuminate conclusions about true market strength. They're looking for what is known as confirmation of a move to detect its legitimacy. I think confirmations are incredibly important to the safety of a move They need to be explained closely. The most important and obvious confirmation, let's say the Dow Jones average hits a new high, okay? Historically, that high will not be sustainable unless the Dow Jones Transportation Index also hits a high or confirms the breakout status of the Dow itself. The Dow Jones Transportation Index is a measure of commerce. It's tracking trains, planes, truck, freight forwarding. Come on, that's a goodie. Really, isn't that a good gauge? If both the industrials and the transports hit new highs, I often tell you that the move is legitimate and it can be trusted. It is real. This is some of the oldest technical work, dating back to Charles Dow, the founder and first editor of the Wall Street Journal, who created the eponymous Dow theory to validate rallies or defrock them. You often hear at the top of the show that I like how the transports are acting. That's because I'm trying to see if the move has staying power in order to bless it. I look at a host of other indicators. The banking index is important to me. The housing index. I look at the semiconductor index, or SOX, and the RTH. That's that all-important ETF that encompasses the big retailers. I like to see all these indices move up in sync before I truly bless a market move for you. You get all these indices rolling higher, you have to put the maximum amount of chips on the table. Oh, boy, but is the inverse true? If we get a move up without confirmation from the majority of these indices, the whole rally could be a fake out and can't be trusted. The classic example, if you go back to the move up to record highs before the Great Recession, you will notice something pretty incredible if you go back and study it. You will notice that there was almost no participation among the financials, the retailers, or the techs. Technical analysis got you out of that market before it was too late if you follow those indicators. Did much better than the fundamentals. What are the other internals I look at? I analyze the advances and declines to figure out whether the rally's too concentrated. I like a market with good breadth or a lot of participation by many different groups. I also look at the new high to new low ratio. Remember, it isn't easy to get on that new high list. First, the company must be doing exceptionally well. Second, the sector's got to be strong. Third, larger forces, the Federal Reserve, interest rates, geopolitical tensions, politics, have to be aligned to make some stocks successful enough to get on that new list. That high list is rarefied territory. You run the gauntlet, you have a good stock, a stock that I probably want to buy on any pullback that's market-related, not substantive to the stock. Hey, and if there are a lot of stocks on the new high list from many different industries, that's actually a terrific sign. So here's the bottom line. You may not be a technician, but you need to know what the charts are saying, and you need to know how to read the internals to verify a real move or a phony one. Stay tuned, and we'll go over a whole host of predictive patterns that suffuse pretty much everything we do around here, not just on the off-the-charts Tuesday, but in stock selection every single day. Jim in Michigan. Jim.
Jim, hi. How are you? And thanks for taking my call.
Of course. Thrilled that you called. What's up?
I got a question for you. In the segment, you were talking about secular stocks. Could you define for me once again, what is secular stocks? And maybe give me an example or two.
Certainly. And look, this is a very important issue because it's a term that gets thrown around. People like secular, parochial. Secular means a secular growth stock is something that does not need the gross domestic product of the world to increase in order for it to be able to beat the numbers. Some of the classic secular grower stocks would be some of the biotechs, some of the retailers that have terrific growth. Gary in California. Gary.
Mr. Cramer, booyah to you.
Booyah, Gary.
Gary from California. My question is regarding dividends in a down market, sir. If you're accumulating dividends on a number of stocks, as you suggest, is it better to reinvest them in a down market or to take the money as cash and then possibly reinvest that in other opportunities?
Well, you see, we don't know when a down phase is going to end, and we know the power of compounding is an amazing thing. So we're going to stick always on this show. I know it sounds pretty pedestrian, but we're always going to opt in favor of reinvestment because fortunes have been made through the power of compounding. I've got to go with that regardless of the near-term consequences because I'm thinking long-term for you. Fundamentals, oh, they're key. But technicals matter, too. Tonight, I'm bringing you into the world of mastermind chartists so you can learn to see the whole picture behind a stock's moves. On Mad Tonight, we know the chart's important, but what technical tool can help you detect floors and ceilings? I'm revealing it. Then, how can you tell if a company's overbought and ripe for a pullback or oversold and ripe for a bounce? And mixing patterns isn't only for fashion. I'm highlighting the patterns worth banking on when it comes to investing. So why don't you stick with Cramer?
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.